Hey guys, welcome back to a brand new video. I'm RexFinance, and today the markets were miserable. I don't think I need to remind anybody, because if you're watching this video, you probably experienced this horrible market today, with the NASDAQ having one of its worst days in history. Think about this. Today, with the NASDAQ being down more than 5%, we created 25% of a bear market in a single trading day. The definition of a bear market is when an index is down 20%. We did 25% of that in a single trading day. That tells you how bad a day like today was. In fact, at the bottom, at the lows of today, the NASDAQ was down by more than 6%. And if it weren't for the last few minutes of trading, we would have had one of the top 20 largest daily percentage losses in NASDAQ history today. Number 20 on this list was negative 6.3%, which we were well on pace for. Now, I want you to look really quickly at the dates that correlate to the 20 largest daily percentage losses for the NASDAQ in its history. The worst day ever was March of 2020 because of the COVID crash, when the global economy literally froze up and we didn't know when it would unfreeze. The global economy pretty much shut down. That was the worst day in NASDAQ history. Following that was Black Monday on October 19th of 1987, which created the first financial crisis. Following that, number 3 on this list is from the tech bubble, April 14th of 2000. Following that is another March of 2020, bad day for the NASDAQ when the global economy was freezing up. Next was the second financial crisis that we've had in 2008. Then we go back to 1987, 2008 for that financial crisis, 1998, which still correlates with the financial crisis of 1987 and 1988, and then the housing crisis, financial crisis of 2008, the tech bubble again, March of 2020 again. The list goes on and on and on. So the fact that today we almost put a new largest daily percentage loss on this list for the NASDAQ should say a lot. Right now, the markets are predicting something very, very bad to be happening. Financial catastrophe even, because in every single one of these cases, something like that was going on. Our financial system as we know it was hampered or destroyed or corrupted. So now you might be wondering why this happened today. Things are certainly bad, or at least they appear that way. Our financial system is definitely not as strong as it has been. The economy still appears pretty strong, but there's some slippage that we're starting to see in some data points. There are definitely some things to be worried about as investors in the stock market right now. But to the level of the financial crisis of 1987, or the financial crisis of 2008, or the tech bubble, or the COVID crash of 2020, it seems a bit worrisome. And there are a few reasons that I'll lay out quickly that I don't think really mattered a whole lot to this big downwards move we got today. There's actually something that I haven't heard much of anybody talk about that I think led to this absolute market collapse today. To start with the not so important reasons, first of all, we simply had an overreaction yesterday to Jerome Powell speaking and him taking the possibility of a 75 basis point rate hike off the table for the month of June. That was a bullish catalyst, but the markets went from being in the red 2 to 3% to being in the green 2 to 3% within just a couple of hours. That clearly was an overreaction, and going into today, I fully expected that overreaction would correct somewhat, at least in the early trading hours, before maybe bouncing back in the afternoon hours. I felt that was a necessary thing because of the overreaction. I talk about this a lot on my channel, but every single reaction in the stock market is an overreaction. Every single one of them. The second not so important reason why stocks started to crumble today is because we got some rough earnings reports finally from companies like Etsy, eBay, and Shopify that also laid out difficulties that the consumers are having right now. That didn't help the markets at all either, especially with Shopify being down 15% on the day. These companies also put out very weak guidance, and remember, all three of those companies are very consumer-centric. They grow their business by selling goods and services to consumers, the average consumer. So the fact that they're putting out poor or weak guidance is not good omen for the stock market or the economy moving forward. The third not as important reasons why stocks collapsed today is because the low rate, high economic growth environment that companies have seen over the past few years is simply cooling off. It's falling back down to earth. The low rate environment we were in was unsustainable. And as a result of the Fed raising rates, obviously that is going to hamper the high economic growth that we have seen over the past few years. And it's natural that valuations would have to crunch if it's not as easy to grow as a company. So naturally, valuations have had to crunch as interest rates have gone up. But I actually found the real reason behind the collapse today when I was doing research for this very video. On Twitter, I saw a couple of tweets that really started to explain things to me. Scott Vopner, I think is how you say his name, he's a CNBC correspondent and host. He said, "I'm told from someone senior at a major firm that the selling is primarily being driven by $12 to $15 billion worth of levered ETF flows into the close, most of which was said to be NASDAQ, driven by the big moves in rates, selling risk really hard." Also, FX Hedge on Twitter said, "Heavy sell volume in triple levered NASDAQ ETFs, liquidations." Basically, what happened today is due to this long drawn-out process, this long drawn-out correction in the stock market. Most equities have been correcting for 7 months now. And also due to the fact that we kind of had the icing on the cake today with those not-so-important reasons that I already laid out, these triple or double leveraged ETFs were forced to sell stock and liquidate. It's very similar to a margin call. And I also should mention that margin calls in general were a huge reason of why stocks collapsed today. Virtually anybody that's been using margin lately probably was dished out a margin call, which either means you have to sell some of your positions to cover your margin loan, or you have to deposit more money into your account to cover the margin deficit. What that causes is forced selling, which causes more forced selling as equities come down lower and lower and lower, which dishes out even more margin calls, which forces even more selling. It's kind of a snowball effect. But I also want to cover, I actually own one of these triple leveraged ETFs in my Roth IRA. I don't think I've ever shown my Roth IRA publicly on this channel, but you can see here, TNA is a triple leveraged small caps ETF. And today, if you can see this small print here, TNA was down 12.5%. So TNA today likely had hundreds of millions of dollars withdrawn from their ETF. Whether that was caused by margin calls on the people that have put cash in their ETF, or simply whether that's due to this ETF being forced to liquidate some of its holdings as their stock holdings have come down, this ETF was forced to liquidate and sell a lot of stocks to either cover all of that money coming out of their ETF or to cover their margin loans if they had loaned any money from institutions. So you also run into another problem when a double leveraged or a triple leveraged ETF is down more than 10% on a given trading day. That causes even more margin calls from investors that have put their capital into TNA, which forces them to withdraw money from that ETF, which forces that ETF to sell more positions that they hold in the ETF, which forces those stocks to go down, which forces the ETF to go down. Again, this is a huge snowball effect, and this is why the breadth of the collapse today was so large. And as an investor, I'm sure you're wondering, when is this going to end? When are stocks going to go back up? Well, the key piece, the key ingredient here that I have been clear about on this YouTube channel that we need to have happen is we need inflation to cool off. As long as inflation stays hot, Wall Street is simply going to be uncomfortable buying stocks. It's as simple as that. We need inflation to cool off. I even made an entire video recently counting down to the May 11th CPI data release, which I think could be a huge bullish catalyst to the markets if inflation shows that it is cooling off. All indications we have are showing us that the rate of inflation year over year is either going to be stagnant or it's going to show a cooling off with April's data release on May 11th. And if that happens, that finally gives Wall Street an excuse to go out and buy stocks. That gives the Fed a chance to take a breather and maybe not raise rates or raise rates less violently. which in turn leads to Wall Street having more certainty, less fear, and less doubt about the stock market. Another thing we need to have happen before stocks really start to recover is we need large cap valuations to continue to crunch down. They've been on a downwards trajectory for quite a while now, but they're still historically at higher levels. Now, after a day like today, this data on this chart is from May 4th, which was yesterday. After today, I would expect that the average forward PE ratio for large cap companies is probably right around 17. Yesterday, it was 18.2, but after a day like today, where most of the largest companies in the world were at least down 5%, I would guess we're going to be around that 17 number, which, if we go to 17, is much more in line with what we've seen in history. Very rarely do we have a stock market correction or a stock market crash that doesn't involve all equities. Most of the time, small caps get hit first, then mid caps get hit, and then large cap companies get hit before stocks start to rebound. This time around, it has been no different. Small caps were the first ones to fall, then came mid caps, and now finally, large cap valuations are coming back down to earth. But again, right now, this sucks. Long term, this is a very, very good thing because it extends the next bullish run that we're going to have in the stock market. Everything I've mentioned in this video has to do with investors currently looking for reasons to sell rather than looking for reasons to buy. That mindset is going to have to switch before we see stocks start to go back up again. I think inflation is that key ingredient. It's kind of the root cause of all the market's concerns right now, but until inflation goes down, I don't think stocks are going to go anywhere but down or stay flat. So what should we do as investors right now? This is very tough to be an investor in this market because it seems like whenever you put money in, just the next day or within the next couple of days, you're already down 5 to 10% on whatever you bought. That is a very tough thing. You want to be investing your money to make money. You don't want to be losing money on your investment. That's another mental hurdle. But if over 200 years of history is any indicator of what's going to happen to the stock market, right now, it's a good time to be buying fear while it's here. Wow, I'm a poet and I didn't even know it. But seriously, I know a lot of people have been buying the fear for months now, but keep at it. Keep buying the fear while it's here because the fear isn't going to be here forever. This is an opportunity, and I believe right now, the current market we're in is going to go down as one of the better buying opportunities we've had in recent history. I'll also leave you with one other note. If you're so afraid as an investor because the stock market appears like it is facing impossible odds, you have likely identified a market bottom. Warren Buffett has been going out and buying stocks like crazy just over the past few months. I expect that sort of behavior has continued for Warren Buffett. And Warren Buffett is the greatest investor in history. If the greatest investor in history is going out and taking advantage of the fear, uncertainty, and doubt in the current stock market, there's probably a good chance that you should be out there buying as well. Now, I'm not a financial advisor. I'm simply a 20-year-old kid for 2 more days. I turned 21 on May 7th. But I'm 20 years old speaking through a microphone to you guys watching this video on YouTube. So don't take anything I said as financial advice. These are simply my own thoughts, opinions, and ideas. It's simply what I am doing with my portfolios. Please do not blindly follow me. Lastly, I don't think I've mentioned it yet, but if you are new here or returning and not yet subscribed, I would greatly appreciate you hitting that subscribe button down below. It makes my day seeing all the new faces come into the comment section and all those things. So with that, I hope this video helps ease your mind or helps you out as an investor. Stay blessed. I'll be back with a brand new video next week. Peace out.